Welcome to Breakout Investors. We are excited to be speaking with the management of DAIO, ticker DAIO, specifically the company's CEO, Bill Wentworth. Joining me on today's call and leading Q&A is Breakout Investor Florian Buschek. This call is being recorded on May 29th, 2025, and will be distributed via the Breakout Investor YouTube channel and our Substack network. Supporting materials and post-call analysis will be posted on the Breakout Investors Collaboration app, available on the app stores and at breakoutinvestors.com. The application and much of the research content is free. We also invite you to join our WhatsApp community, which is linked to in our YouTube profile. So let's get the call started with me handing it over to Bill for a brief presentation with Q&A to follow, led by Florian. Bill?
All right, great. Thanks, Josh. And thank you for tuning in. I'm Bill Wentworth, CEO of DAIO. We'll go on to the next slide. Let's go to full screen save here. Oops, sorry. All right. So a safe harbor. So DAIO has been around and was founded in 1972. The genesis of what we do is we create embedded hardware with software that delivers and provisions data into silicon. So it does that through a variety of different proprietary programming languages and hardware, mainly through an FPGA. So the company, again, founded in 1972, and this is around the time that integrated circuits first hit the market, and allowed engineers to be able to design products basically with unique silicon that allowed them to basically program data or through blowing fuses have input and output desired outcome on the design, which allowed really the proliferation of a lot of electronics and technologies that we use today. And through that evolution, which we'll go through some of that in the presentation, has allowed the technologies that we use today, such as cell phones and the technology that are in cars nowadays. All of that technology was really driven by silicon consolidation, but also mainly by programmable technology. OEMs and service providers choose our platform for the quality of our algorithms, the extensive device support library that we have. And device support, and you'll hear me talk a lot about this, is really where customers really make their buying decision. DAIO has a great brand still in this field, over 50 years. It's been known as the go-to provider for this technology, although we do have more competitors now that have scaled up a little bit. And I'll talk through how we're going to get back to gaining market share and evolving the business, not only in what we do today, but there are adjacent services that we're pretty excited about that we can add to the portfolio products that we have. And I think that's really an exciting upside for the business, as well as the technology hurdles that are coming, such as UFS and MVE and other memory technologies that are causing, not causing or creating, I would say, larger technology hurdles to get over, whereas where your people are going to make a big difference in how you lead through that and overcome those technology challenges. We have about 100 employees, 50 of them in Redmond. We do have a manufacturing facility in Shanghai. That's proven to be a blessing given this tariff challenges that we've all experienced. And actually, the order that we just got awarded this a couple of weeks ago that we announced today publicly, that was built and shipped in mainland China. So that obviously it was nice to be able to do that in country. One of the things that, my intersection with this technology actually goes back to when I was a teenager. My dad was an entrepreneur, owned an electronics distribution company that eventually was sold to Arrow Electronics. And so in that time that I worked in my dad's business, it was programmable technologies were coming out that time. And I actually was using DAIO equipment at the young age of 14, 15 years old. So my history goes back with this brand quite a bit. From that experience, I actually started my own business at 21, and it was a programming services business. And DAIO was my number one supplier for the first 8 years of that business. We, over time, became the number one global service provider, and I eventually sold that business to Avnet in 2008. So I really come from this, from a viewpoint of what does a customer need? What do they want? What's important to them? Because I was a customer for those that, for almost 30 years, and we consumed more of this equipment than any other company in the world at that time. In Avnet today, those same programming centers are in that a part of Avnet's portfolio and are some of the largest programming centers in the world. So one of the things I noticed when I came back to DAIO as a board member is that I saw that the product portfolio was missing a few important links, such as manual programmers, which we have up here in the slide. Those are newly reskinned that we reskinned back in December. We have some new product releases that we're going to be doing at the end of this year that are pretty exciting around this theme. And on top of that, we'll be rolling out our product roadmap next month sometime in an announcement. So coupled with the fact that we are, realigning the business to really the supply chain in which programmable technology gets deployed, it's important. This is a very important aspect of this because if you think about the U.S. market, it's an engineering community. It's the same. There is some manufacturing still here in the U.S., but not like it was in the 90s. So it's important to have these types of products so that engineers can use them as they're developing new technologies and using the newest silicon out there. And we want to we want to be in that cycle as early as possible. Because obviously you get the device request, which then we have to write an algorithm and produce a socket in order for that part to be used and consumed. But then when it gets pushed to manufacturing, you're already on the print as the approved supplier. So it's really important that you start in the beginning of that process as early as possible. To take that one step further, one of the things Data.io did really well in the late 80s and 90s was they had real good alignment with the semiconductor manufacturers, meaning they had people that actually called on them directly, and they would get these engineering units in their hands and at the silicon vendors and be early on in that product release cycle. So we've signed 5 formal contracts in the last 8 weeks to be part of that pre-production release of their technology so that we're upfront developing the algorithm. We understand the packages that they're going to be using in volume. We can get the sockets tooled up and be ready for when that product hits the market. So a big part of our world is really that engineering community, both at the silicon vendors and at the OEMs as well. This enables us to deal with special features and settings and not be playing catch up or being reactive to customers' needs when they've already designed their product with it. And historically, if you look at our, and I'll get into our go-to-market, there's 3 main markets that we serve. And there's different attributes in each one of those markets. And so it's important that you have a comprehensive product portfolio to address all those different needs. So this goes into kind of our unified programming platform. As I talked about earlier, the manual systems are the beginning of that. So if you think of those, the boxes in the middle, the manual systems, that is our intellectual property. That is what we create, and that's what we call our platform. And that platform can be surrounded by, an automated system for pick and place. But the core of what we do is not handlers. It's the programming platform itself. And so, whether it's small, medium lot sizes or, first articles or MPIs, the manual systems are used for that. Then the platform can get embedded into a larger handling system to do high volume programming, marking, tape and reel, final packaging that would go into the manufacturing lines of those manufacturers or large contract manufacturers in Asia. And then at the end, the managed systems can be used for post SMS, estimate, process, test, rework. There's repairs, things that they may have to do small lots or, 1 or 2 parts to repair a board. So as you can see, our product can be used through the entire product life cycle of an OEM's technology. This is a look at our customer base. As you can see, we do serve very large Fortune 500 companies globally. Traditionally, since probably about 2013, our business has been very focused on automotive. There was a reason for that. When large memories came out, such as eMMC, the management team at the time were able to develop a product that could address that large density flash at the time. And so thus they ended up with almost 60% of their business being automotive. that also creates a problem because unlike, companies can have customer concentration, you can have domain concentration. And that's a reason why the business really started to slide last year as the automotive industry went through its own little bubble. AVs were obviously a big part of, the automotive industry growth, and it still is, especially in places like China. That's why we were awarded the order we got was automotive in China that we got a couple weeks ago. So it's still, healthy in some regions of the world. Europe is still, fairly slow. There's a lot more competition there for EVs as well. But not all our technology just goes to EVs. It's through, combustion and hybrid engines as well, and the parts that are used in DAS systems of safety and security and things like that. There's so much programmable silicon in cars nowadays. It's quite amazing. It takes almost 8 hours to code a BMW 750. That's how much coding there is in these cars nowadays. So, to talk a little bit about our go-to-market, so automotive is still strong. It's still a big part of our portfolio. I don't see that changing in the future, and it's great foundational business because unlike other tech industries, whether it's networking or mobile phones or data center equipment, they don't change that much. They build a model year and they pretty much know how many cars they're going to build a year over year. And it's one of the reasons why I've always liked the automotive business, although they're a difficult customer to satisfy. But if you can satisfy an automotive and customer, you can pretty much meet most customers' demands. That being said, the large, what I would call service provider network, which would be the Arrows and Avnets, global distribution companies, independent distributors, contract manufacturers, they're taking orders from customers that have already designed a product. So they're very reactionary in their needs when they come to someone like a Data IO. So it does require a slight different business model to service their needs because they do send a lot of device requests and they don't get every order. Sometimes they're in a bid process, but it's our job to service that client because quite frankly, the service provider network has a much larger market opportunity for our technology than all of automotive put together. So for example, Avnet in their Singapore facility has 75 automated systems. Our largest direct customer has 20. So there's a lot of upside for us there. Traditionally, distribution probably accounted for 20 or 25% of the revenue of Data IO, and it's less than 9% now. So we have some work to do there. The good thing is the company itself and the people I brought in have great relationships in those regions, those areas. Some of them sold their services for years as business development folks, so we know the ecosystem and the culture pretty well. And then there's industrial, medical, and also I think robotics is also going to be a significant amount of market. I think there was a growth for us. We've got a couple POCs and a couple different robotics companies now as they start to build out that technology. I think there's somebody on CNBC said this morning that they felt within 5 years there'd be 10 million humanoid robots out manufacturing. I'm not sure I trust that number, but it will be something in a significant growth market, I think, for our technology. And then also on top of that, in the 90s, there was quite a bit of silicon that was being consolidated from logic to programmable logic to CPLDs. I see the same organic opportunity happening in 2027, maybe late 26, where we could see an expansion of our organic market. And so that's exciting because one, as we roll out our new product roadmap, which we do believe will be the best programming platform, universal platform in the industry, definitely by the end of 26 is when our version 2 comes out. But also to couple that with being able to take market share because of our technology advances, but as well as organic market increases, I think there's a really bright future for our organic business for growth. Let's get back here. And this is really where the center of this slide is really where that's our IP. We have two platforms today. We are moving FlashCore 3 to LumenX. That migration has already begun. The goal is to have one single platform that our customers can use across different solutions, whether that's manually or through our automated systems, our version 2 will also have the capability to plug into board testers or inline, where data is also provisioned to the silicon. So that way we can address a wider part of the market, because offline programming is probably about 20% of the devices in the world probably get provisioned offline. Could be a little bit more, could be probably not less, but a majority of them are still done in other techniques such as inline or at test. And we want to be able to take our platform and marry it up with those different types of technologies so that we can capture more market share. All right, that's all I have for the slide deck. I appreciate the time.
Florian, I'll kick it over to you to kick off QA.
Awesome. Thanks for the overview. Maybe could you you're in a very technical business.
Yeah.
Could you maybe in 2 or 3 sentences summarize what you do, what problem you solve?
Mm-hmm. Yeah, so the problem we solve is the silicon that's created by semiconductor companies such as let's see, a Xilinx or a Micron or an Intel or a Hynix or NXP or any of the Renaissance or any of these microcontroller companies. These parts come out with basically a blank piece of paper. And an engineer will take that device and say, I want it to do functions X, Y, and Z. And they write code. And that code is written in a usually C++. So we take that code and we wrap our software around it and deliver that code through our technology into the device itself. And then that device is then put into a cell phone or a car or a piece of data center equipment or anything, industrial controls, things like that, mobile phones. And so that's basically what we do. We take something that's fairly complex, and you're right, I probably should have started with a forward statement as to exactly what we do, because it is fairly technical. You're right. What we do is very complex, but we make it very simple. We take a complex technology and make it simple for our customers to use. So basically, we're taking that engineering file that was created during the design of that product, and we provision that to the part to allow that product to come to life, essentially. Does that help?
That's awesome. Yeah. And
Yeah.
I think it's fair to say you are in a market that is secularly growing.
Yes.
Fantastic. Yep. What differentiates you from your competition? How does the competitive field look like?
Yeah, sure. So the competitive field's changed a lot in the last couple decades. Like I said early on, as a service provider myself and a customer, DAIO was probably back then 70% market share. They were first to market. They had a great brand name, still do, known for high quality algorithms. That's one of the things that people still come to us for. The people we have, there's a lot of people that have been tenured here for probably 10, 20. There's people here that have been here for 30 years. There's a lot of ingrained knowledge and domain knowledge across our technical staff. It's one of the reasons why we were able to get over the hurdle of this UFS technology that we were able to develop early in this year for that order. So I believe it's our technical capabilities and our engineering talent that definitely floats to the top when I think about whatever our competitive advantages are. I think obviously the brand helps that because people have worked on this brand. I've run into investors and talked about it. It's something where engineers are on the career and they remember the brand. So it's been around. It's stuck around. But I think this point going forward, there's a renewed energy, and I think also with the challenges of silicon that are coming up, it certainly has our engineering staff pretty excited about developing new platforms and new capabilities within our platform. And I think our global reach, we've got a great footprint in Europe and our German office. We've made some great inroads since the early 2000s in Asia. We were building over there long before some of our competitors. So we've got an early, good presence there. And here in the US, we've been a known brand. So I think through that, and the fact that we have a pretty good, healthy balance sheet. We've got 10 million or so on the balance sheet. We can invest that capital, and that's one of the things that the company has not done a lot of is really a good use of capital allocation. It's one of the things that is important to me is we put a dollar to work, what are we getting back for that dollar? This is a transformational year for us, I will say that, but the good time is it's a little bumpy, obviously, because the tariffs has caused some people and customers to, kind of hold off on capital expenditures right now. They're not canceling them, they're just kind of holding off to see what happens. Um, but I believe that, this is a great time to invest because it's a lot harder to do it when you're fat, when business is going, is busy, it's harder to make change. So right now we're making a lot of investments internally in technology and automation. We started using a little bit of AI to do things in engineering a lot faster, such as reading through documents of these programming specs. Sometimes they could take a day to go through. We can do that in minutes. So we're looking at ways to use automation to become more efficient across the entire business as well. I think we come out the other side, that gives us a lot of competitive operational leverage, better margins, and also, through these investments, we'll have better technology as well.
You spoke about a couple of things that I want to drill deeper on. I
Sure.
will ask a bit later about capital allocation and your background, but since you
Okay.
mentioned tariffs and China, you also highlighted in the press release today that these units will be manufactured in your facilities in China. So you have facilities both in China as in the US, and you are basically pretty flexible to manufacture for markets worldwide. And that should also help you with regards to tariffs.
Yes, absolutely. Such as that order that we received, there isn't a single component on that system that is affected by tariffs at all. So that is the beauty of being able to source both in China and also in the US and share some of those vendors as well. Obviously, sharing is a little harder because of the tariffs, but we've been able to reclassify some of our, when things like this hit, you tend to go through these exercises that you probably don't usually have to do. And, there's certain classifications that all your parts come under for shipping, to other countries. And so it had us go through that exercise, and we did end up having to reclassify some of our products, which actually made it easier to import and export and avoided, the higher tariffs. So it was actually a good exercise to go through. So we feel pretty good. If this tariff issue continues, there are a couple parts we do source from China. We can build in Germany, in our German location. We'd have to ship kits, but we could build there. And we're also looking to have a secondary plan in Asia, either in South Korea or Thailand, to build there as well. So I've got a field trip coming up to do just that. We did go over recently to train our Shanghai staff to be able to build our premium unit, the 7000. So we're pretty well coupled there, both in the US and Asia, for building all machines, all models.
Yeah, I think that's fantastic and really worth highlighting, because there is a big push. Let's just use as one example in China, car manufacturing, EVs, and it's a big worry certainly in Germany that they are eating our lunch, right? And you are sort of independent of that, because you can work with all of those manufacturers, be them in Germany, in China, or in US. It doesn't really matter to you.
No, it doesn't, and that's a great point, because the UFS challenge that we overcome, automotive industry is a large consumer of UFS memory. It's multiple layers of silicon stacked on top with a small instruction set on how to parse that data across those levels of silicon. And this is kind of the technical prowess of our engineering staff to be able to overcome those challenges and do something that our competition is struggling with. And as we roll through our product roadmap and allowing for newer and future technologies to be able to be consumed on our platform, allowing that platform to be able to run 10 to 15 years from now. We've gone through product roadmaps with those 5 silicon vendors that we partnered up with, and they have on their product roadmap a 1 terabyte flash part coming out by 2027, which is just simply incredible. That is 3x the density right now. That it's kind of the mean density of UFS. Those parts are going to take a long time to provision, which is why I believe our market, our available TAM is going to expand organically, because you're going to have to take those memories off. If you're doing them inline now on a test jig or at test or inline, you're going to have to take them offline because it's just going to slow down the manufacturing rate. So they'll have no choice but to pre-program those devices on equipment such as Data I/O.
Then you had a very nice press release today. You also just, I think a couple of weeks ago, announced the largest order in the company's history.
Yep.
Can you talk a little bit about what is happening right now, how we should think about those orders, and what they tell us about the future?
Yeah, sure. That order, the order a couple months ago, a month ago, was from an existing customer that was buying socket adapters. So they have a portfolio of products that their salespeople are selling into their customers, and they looked across that breadth of product and said, you know what, we're going to make a commitment to Data I/O. So they bought multiple sockets across multiple different silicon technologies. So what it does is it shows a commitment to our platform when a customer makes that big of an investment, because sockets is what drives consumption. Consumption drives your platform sales. So the more sockets you sell, it's a good barometer for our business and where it's going. Is a direct effect and a direct correlation to the consumption of your platform. So when you see large socket orders like that, and we've gotten a few over the last, not any that I would, make a big press release over, but that was such a large order, it was worth talking about. But we've seen more and more of those. And when times are slow like this, you'll see customers try to just use the existing platform that they've already invested in, the capital equipment that they've already invested in, and maybe run an extra shift or two. So you'll start to see more, sockets. You'll see those numbers increase. But that's also a good thing because obviously they committed to your platform. So all in all, about half our business is recurring from sockets and upgrades. The other half comes from system sales and software and things like that, software contracts.
Great. Then regarding capital allocation, what are you looking for? And maybe also touch a little bit on your background.
Yeah. So, do you want me to help? Obviously, started my industry in tech and started in this space in particular. Started my own company in 2020, in 1988, providing programming services mostly to OEMs in the New England, Boston area. And then grew that business nationwide. We opened up in Fremont, California, started to service a lot of silicon vendors back in the mid 90s. Then as manufacturing started to shift to lowest cost regions such as Mexico, we opened up in Guadalajara. And that was around 2000. And then I sold 65% of the business to HIG Capital in 2001 so we could expand internationally because we were mostly with asset lending banks. We can only grow so fast on their shoulders. So brought in some outside capital, maintained a 35% ownership in the business. And then we expanded to Shanghai, Hong Kong, and Singapore, which is Avnet's largest programming center today. Expanded into Brazil and into Europe, one location in Eastern Europe. So I've been through global expansion, been through also some significant downturns in our industry. We sold to HIG in 2001. It was March. The very next month, our WIP was 50% of what was the month before. So been through and had to steer a ship through some pretty tough waters. Lived on cash month to month. I never want to do that again for 3 years. But we came out the other side and we were a completely different company. And so taking businesses that are struggling with their go-to-market or their product portfolios or services that they offer is something I've been conditioned to be able to manage. And I did the same thing at Avnet when I took over their services businesses. They had acquired 12 companies. I think 7 of them were losing money at the time. I got them to break even within 9 months. So it's, they're tough choices, they're tough things you have to do. There's a lot of cleanup work. And like I said, Data.io is no different to that, no indifferent to that. So there are some things that we've changed. I've moved out some management that I felt didn't really understand the business as well as they needed to. So we've rolled some executives, consolidated some operations of the company. We're now going through an IT scan where we're consolidating our IT vendors and increasing our use of automation, which will allow us to scale the business and look at things like M&A. I've done a lot of M&A in my time. When I left Avnet, I spent the last, from 2015 till early 2022, working with private equity firms, building business industry theses, mostly in tech, mostly in IT services, but finding a platform company and add-ons around a certain thesis. So very comfortable with M&A, have a lot of experience with it. There's an art to it, but there are some good adjacent plays both upstream and downstream for Data.io to look at.
Very nice. Do we have any questions from the audience? You can raise your hand. Until that time, let's talk about, you mentioned the usage of AI and cost reductions.
Yep.
Can you talk a little bit about how we should think about your operating expenditures going forward?
Yeah, sure. Well, given the AI and it's accelerating almost daily at this point. One of the things as a board member is looking through engineering and writing code and the things that AI was bringing to the table. Um, you could see where certain areas of the business could benefit from using AI. And like I said, in the engineering example that I used earlier, we have these documents that the engineers have and scan through 500 pages of a spec of a device. And sometimes the silicon providers provide a very specific programming spec, but a lot of them don't. And so they have to scan through looking for those values that fill a specific table in order for us to write the algorithm for our platform. So, you know, we did a POC, spent about $100,000 on that, and came out with being able to save almost a day or two on reading those specs, which will allow us to take on more device support requests from our customers and produce more algorithms, which obviously then consumes our platform and turns into revenue. So, things like that, I think at the coding level, it's still got a ways to go. I think we're probably 2 years away from using an AI agent and an LLM model to be able to start writing parts of our algorithms, but I don't think it's that far away. I think there's also places we can use it from analytics, but also from service. We're looking to move from our current service module to Salesforce Service Cloud. We do a lot of field service. Obviously, we got equipment, almost 500 systems in the field, and there's a lot of things that come through those portals that tell us something. That tell us a story. The customers obviously are putting in data and putting in for service requests. What is that data telling us? One of the things that I noticed in coming on board is we have a lot of data, but it's not very consumable. So one of the things I also did was we signed up for Snowflake and have an instance of that. And we're starting to use our systems of record to move that data into Snowflake so we can better analyze the data. And sometimes that data can be monetized. And so we're looking to, take that data, understand, what can we learn from it? It'll help us develop better systems in the future, service our customers, but also as that data gets collected, Salesforce has some AI models that can take and do level 0 and level 1 support calls, which also saved us from taking time away from an engineering staff. So I think a lot of productivity improvements in the out years across the board, both from monitor our data and being able to look at it and use real good business intelligence, but also use AI to be more productive and scale.
All right. Once again, any questions from the audience?
Florian, I'll jump in with one. Bill, just when you
Awesome.
look at what the future holds, obviously we can't talk about short-term guidance, but
Yep.
what does success look like from your perspective on a 3 to 5 year kind of horizon? What
Yeah,
what are
sure.
you hoping to achieve?
Yeah. And if I look at just the organic market itself, say we're on 25, $26 million in revenue today, success organically, just from kind of offline programming, not inline, just offline, should be a 50 to $75 million company, maybe larger, in 3 to 4 years. But then if you look at tests and inline, tough to get some numbers around that because to understand how our technology will fit inside their technology as we deliver our service. Um, but that could be another 25, $50 million or more. But then there's the adjacent plays, engineering, there's tools and technologies out there. And I've seen companies anywhere from 10 million to 30, $40 million that would be worth buying, and merging and offering a much larger suite of products. So, if you start stacking that up, you could see, sometime in the future, this could be a 125, 150, $200 million company going upstream, downstream, and then obviously rounding out the core of what we do today.
Excellent. You touched on this earlier when you were giving your background a little bit, but I maybe want to just tap into a specific question. What specifically caused you to come to DAIO, right? You obviously have a very impressive background. You
Yeah.
obviously have, the relationship to this company in the past.
Yeah.
It almost seems like you maybe have the chops to be working at a larger company somewhere,
Oh,
right?
yeah.
So why DAIO?
Yeah, it's interesting you say that because I look back and when I started Source, I'm trying to think when we crossed that $25 million threshold, it was probably 1994 or something like that, right? So since then, I've run companies, 100, we got Source got up to about 130 million globally just doing programming services. And that's the other thing I didn't mention. Services is also a place we could skate to. Um, and so that's not something that I've laid out, but I can see a go-to-market strategy where we wouldn't compete with our service providers in that space, which would be an interesting growth engine as well. And I, went to Avnet when we sold Source and we combined, Avnet's programming capabilities with ours that doubled the size of the business from the silicon that we touched. So if you looked at the average ASP of the part, the supply chain that was running through our business, it was about a $1.2 billion business that we started at 400 million. So we tripled that business in 4 years inside of Avnet. We had the highest gross margin and highest net profit across the 43 P&Ls inside of Avnet. We ran about 8.6, which is pretty healthy for a business inside a company of that size. They were 18 billion when I sold, 28 billion when we left. And then the services business I ran for Avnet was about a $500 million global business across, Europe, US, and Asia. So yeah, I've run larger businesses, but I think the unique thing is I've also run smaller businesses. A small business culture is just far different than obviously a large corporate culture, and so I haven't forgot where I came from, and a lot of values that my dad taught me, I brought forward into a large company culture and made some really good changes at Avnet, that I'm proud of. One of the things that Avnet's bought, I think, over 120 companies in its history. And I remember one of the senior executives saying that, a lot of the CEOs of these small companies that they buy, they don't stick around and they not commit. And, it was a little jarring match, but, I moved to Phoenix and I was committed to help them grow the business. Because when I sold the Avnet, just like at HIG, it was right after that was a major financial event in the market. We hit the '08 financial crisis right after I sold the Avnet. So I guess two well-timed events, but I didn't leave. I mean, I could have left. It's not like I had to stay. I had a 2-year contract, but I'm proud of the business that we built and wanted to make sure that the money that Avnet and HIG invested in me and the team, that it proved to be a great asset. And in both cases, they were. I mean, in HIG's case, our asset was written down to zero in the fund, and we returned $62.5 million. So I take a lot of pride in that, and if shareholders want to invest this company, my goal is to make sure they get a great return.
Fantastic. Going back to my prior question in terms of where you see the business in 3 to 5 years,
Yep.
You're talking about some pretty good upside. What do you think the biggest challenges, risks, hurdles will be to get there?
Yeah, DataRail hasn't done a lot of acquisitions. The last time they did one was probably back in early 2000s. So you've got a staff that hasn't really been through those. The good thing is I brought some people that have on board. Yeah, M&A is always a challenge. I mean, for any company of any size. So, it's how you execute those. I think I've been through it enough now to understand the science. A lot of people talk about, you got to match up the corporate culture, but the big part of the art of M&A is really what are the strengths and weaknesses of each company, and do they align where one and one does make two? So I think M&A doing that in an accretive way, but also adds tremendous HR, human resource value and technology value. That's always a challenge, but it's one I feel pretty good about being able to align ourselves. And I think, look, the industry as a whole, there are a lot of supply chain shifts going on. I mean, the more and more this tariff stuff goes on, there is a significant amount of shift going on in Asia right now, out of China into places like India, Southeast Asia. We need to get well positioned there. So that's a challenge that I see right now that we're working on. And so that decoupling of the global market, it's a concern, but it could be an opportunity as well. So I think it's just scaling, honestly, the infrastructure. That's always also a big holdback. If you look at a lot of acquisitions as I have in the past, some of the bigger mistakes are not integrating your IT systems, because you end up with not being able to you really put to work what I believe is, when you do acquisitions or even grow, is best people and best practices. And if you live by that, you can build a great company. So, a lot of times the buyer company feels like they always have the number one position, but that's not always the case. It is something I learned from Avnet that they do very, very well. It's a reason why, they've been very successful of doing M&A, but also controlling the organic growth, because you can also grow too fast. And I've been through that. So I think it's really making sure you have the infrastructure and the right people in the right seats so that you can, valve control that growth and make sure you do it effectively and more importantly, profitably.
Excellent. Florian, that's all I had, so I'll turn it back to you.
Maybe can you give a little bit more information about what you changed since you arrived at the company?
Yeah, sure. It's the previous administration, the CEO was running sales. I brought in a VP of sales and marketing, that actually used to be someone that covered my source as an account manager, as actually VP of sales at BP. Monty Reagan is his name. So he's been involved in this industry for many, many years. I actually hired him at Source, and then he came and worked at Avnet. So he's been on the equipment side of the business, but also the services side. He started the very first week I did. I think as CEO to run sales is somewhat of a conflict, but also it's not going to get the right attention that it needed. So Monty's done a great job of really changing how we use Salesforce, CRM, really meticulous and really rigid around, pipeline management, expanding the pipeline, holding salespeople accountable for their efforts and accountability, and also really changing how we're going to market the business. But on top of it is that rigor in sales is what it really needed a lot of. And we've also changed the conversation. We don't go and talk about part numbers and, buy this automated system or that automated system. We talk more supply chain. We're much more consultative in our approach. And I think the customers really appreciate it. And that really showed up at the Apex show in March. Jennifer Higgins, who's been our marketing and been at the company for over 25 years, she's run marketing for the last 10, at least the shows. And she said it was the best Apex show they had since 2013, based on the numbers, qualified leads we got, new leads that we got. And it was the same attendance that at the show last year as it was this year. So I think changing the conversation, rolling out these new products has really changed. So Monty's been a great asset. And then also we have a new head of hardware engineering, John Duffy, who comes from a lot of VC startups. So he's used to that small company, fast environment. The day he started, and January 6th was the day I said, "Hey, guess what? We have to develop a new platform, and we need it by June 1st. So welcome aboard." He has taken on that challenge, and he's doing a phenomenal job. I mean, we are we are on time with all our milestones so far. We've got our new V1 milestone being hit sometime in the next week or two. So yeah, he's done a great job picking up that team. I've also moved the algo team over to him globally as well, because that I felt needed to be coupled closely to the hardware design, because it's such an intricate part of the embedded product that we make. We've got our CFO had retired, so we're on the search for a new CFO. And that's a really important role to me, because I've always had the CFO as a very, very close partner, but not just from the numbers, but also the understanding of the business, so we can have conversations like I'm having with you today. And so the CFOs in my past have always really known the business. Not that I'm going to know it as well as I do, but know it well enough that when we sit down and have a conversation, a strategic conversation, he understands where I'm going. I understand where he's coming from, or she, and we can have that business conversation, and it's fluid. So it's important that the CFO also is business like-minded as well. So that's an open position. We're in search right now. And we've really instituted some good, I think, rewarding programs internally for the company. I think the culture has really changed. The board noticed that the word last face-to-face board meeting. It's become more of a team, much more. I was parachuted in last summer to look at a couple of the projects that they were working on, and I can tell you from firsthand, the culture's really changed for the better, and we're seeing a lot more productivity. So I think that, and then the adoption of some new IT systems are going to make some big changes. We're paying a good amount for IT, and the IT is not, we're not getting what we pay for. So I think that those investments in both automation and Salesforce Service Cloud, those are all going to allow us to perform better for our customers, and also allow our internal resources to be more productive.
So the capital structure is very clean. You're
Yep.
sitting on a lot of cash as well.
Yep.
So that's always good to see, especially in a microcap company.
Yep.
Can you talk a little bit about your shareholder base, maybe insider ownership?
Yep.
In that regard?
Yeah, so we've got some pretty long-standing shareholders. Dave Kanan and his fund, they've been in the stock for a while. I think they were out for a little bit, but came back in. I've invested my own capital a couple weeks ago and bought shares on the open market just to show my faith in the business and where we're going. I'll probably be doing more of that. And I'm going to be in New York City the week of the 16th, meeting some new investors and existing investors to talk more about the story and where we're going, get them some updates. So I think, we've held pretty steady. Some people have fallen out of the stock, prior to my announcement. I'm going to be meeting with some of those folks too. It's always good to go back and find out, what they liked and why did they invest in the first place and why did they leave, and talk to them about it, and to assure them, like if you're going to invest now, these are the things we're doing moving forward, and maybe you might want to take another look. So I think from a stock base, there's been some good foundation there that's been there for a while. And I think, they've all liked the story, at least back when I was there in October. So we're going back to do kind of a refresh of those meetings, and looking forward to them.
Very nice. Yeah, I did take note of your insider purchases,
Yep.
because I think there is a worry out there that the tariffs, even though not directly, but certainly
Yeah.
indirectly, will hurt you in some way. And that may or may not be true, but over the medium to long term, it certainly seems like you are not really worried about it. Otherwise, you wouldn't
No.
have picked that day to buy.
No, exactly. Yeah, exactly. Well, and look,
So-
has it delayed some orders? Yeah, I mean, at this point last year, we had shipped 3.3 million to Korea. We haven't shipped anything yet because the whole country's put capital equipment on hold. The big companies, LG and others. But their forecast of this year, going into this year, was very strong prior to those tariff discussions. So orders didn't go away; they're just delayed. So the second half, and look, we've got a lot of product announcements coming out in the second half. we're going to create a lot of activity on our own organically. This tariff noise goes away and things come back down to a normal playing field. I think things should be pretty exciting in the last 4 months of the year.
Yep, I would agree. Last chance. Any questions from the audience? Otherwise, we are almost an hour in, and I think you gave a really, really good overview. You had some
Thanks.
very good answers to all of our questions, and
you.
I am excited to be part of the story going forward.
Great. I really appreciate the time, guys, from the Breakout Investment Group. I was really looking forward to this meeting, and I'm glad I could share the story, and glad to share that excitement.
Yep, you did not disappoint.
All right, great.
So-
Thank you. All right. Well, listen, I hope everybody has a great day, and look forward to the future.
Yep, thanks again, and
All right.
keep up the good work.
All right. Thank you. Bye-bye.
Thanks, Bill.
Thank you,
Bye.
everybody.
Thank you.
Bye-bye.
Some or all the speakers may maintain positions in the securities discussed in this podcast. The views in this podcast expressed are those of the speakers and not Breakout investors. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Neither Breakout Investors nor any of its affiliates makes any representation or warranty, express or implied, as to the accuracy or completeness of the statements or any information presented by this podcast and any liability, including in respect of direct, indirect, or consequential loss or damage, therefore is expressly disclaimed. No one on this podcast is an investment advisor, and no one is providing investment advice. Before investing in any company's stock, you must do your own research. Thank you for listening.